The Australian stock index is risky from a fundamental point of view. The largest Aussie ETF by assets under management is Vanguard's VAS 300, VAS, which is an index fund tracking the largest 300 companies listed on the Australian Stock Exchange. Although this ETF is market cap weighted, so in principle you're investing in the top 300 companies, but by weighting, 60% of the ETF is made up of just 19 companies. This is the first major risk, which is an overconcentration in just a few large companies. If we take the top companies that constitute at least 1% of the ETF, we end up with only 19 companies composing 60% of the total fund. Being that these companies make up such a significant portion of the ETF, we need these to be high-quality companies that are consistently growing their revenue and earnings per share, preferably year over year. If we look at the top company in the index, which is BHP at 9.3% of the ETF, we see this is not the case, and over the past 10 years, the revenue has actually declined from $57.3 billion to $55.7 billion. And we see that there was a major slump from 2014 to 2020. Their earnings are only slightly better, having barely grown over the decade, and with major cyclicality. This pattern of cyclicality and slow or no growth is thematic of the top companies in the Australian stock index. And the average 10-year revenue growth for the top 10 companies is only a compound annual growth rate of 2.7%, and the 10-year average earnings per share growth is worse yet, at 2.1%. This is the other major risk of the Australian stock index: slow fundamental growth over long periods of time. The next fundamental risk is an overconcentration in just two market sectors, with one of these sectors being extremely cyclical. The top sectors by a long shot are financials and materials, with financials making up nearly 30% of the fund, while materials make up about 22% of the fund. The financial sector is slow growing and inconsistent, which we can see by looking at the earnings of the second largest company in the ASX, the Commonwealth Bank of Australia, which we see graphed here. Or if we look at the next largest financial company in the index, the National Bank of Australia, the bottom line consistency and growth is even worse. The next largest sector, the materials sector, is especially sensitive and cyclical, which again can be visualized through BHP's net income over 10 years. So in summary, the major risks of the Australian stock index is overconcentration in just two industries, those industries being cyclical, and their top companies being slow growing over long periods. But how has all this affected the total return? Well, over 10 years, this ASX fund has annualized returns of 8.2%, which is surprisingly good, but compared to the S&P 500 with a total annualized return of 12.4%, this is extremely poor, considering the returns are annualized. So a $10,000 investment 10 years ago in the Australian stock index would have yielded about $22,000 today, compared to the S&P 500, which would have yielded $32,000, which is partly because the top companies in the S&P 500 have strong fundamental growth in revenue and earnings per share, like we can see through the largest holdings, Microsoft, Apple, and Nvidia. Better yet, the top companies in the S&P 500 source their revenue from around the globe, while Australia's companies are more domestically centered. Do you have an Australian super fund? If so, what are your holdings? Thank you for watching.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.